I want you to take a moment and think about where you were this morning when you first looked at your phone. It was Thursday, January 22nd. You probably woke up, reached for your device, maybe expecting to see the usual chaos, a political scandal, a weather report, maybe a sports score. But if you follow the financial markets, if you pay attention to the pulse of the global economy, you saw something that likely stopped you cold. You saw a number on the screen that didn't make sense in the context of the world we were living in just yesterday. You saw gold blasting through $4,700. You saw silver trading in the mid 90s, and for a split second, your brain probably tried to rationalize it. You thought, is this a glitch? Is this a typo? But then you refreshed the page, and the number was still there. In fact, it was moving higher. This morning was not a normal morning. This was not a standard market fluctuation. This was a detonation. What you witnessed while you were sleeping was the sound of the global financial system snapping. It was the sound of the world waking up to the realization that paper promises are burning, and the only fire exit is made of metal. We are no longer in the realm of speculation. We are no longer talking about what might happen if the Fed pivots or if the debt gets too high. We are watching it happen in real time, in high definition, right on our screens. The dam has broken, and the water is rushing in faster than anyone, even the most bullish stackers, anticipated. Today, we are going to have a very serious, very deep conversation about what this means. We are not going to talk about price targets or moonshots. We are going to talk about the structural collapse of confidence that is fueling this fire. We are going to connect three separate infernos that are raging across the globe right now, in Europe, in the US bond market, and in Japan, and show you how they have converged to create a perfect storm for precious metals. And most importantly, we are going to talk about what you need to do now, because the playbook has changed. The rules of engagement have shifted overnight. If you are still playing by yesterday's rules, you are going to get crushed. But if you understand what just happened, if you understand the mechanics of this squeeze, you have a chance to not only survive this transition, but to come out the other side with generational wealth. Let's start by peeling back the layers of this geopolitical shock, because it is the gasoline that was poured on the fire last night. The headlines are screaming about trade wars. You see the US administration escalating tensions with Europe, threatening tariffs, making aggressive moves over Greenland. On the surface, this looks like standard political posturing. It looks like negotiation tactics. But the market sees something different. The market sees unpredictability coming from the issuer of the world's reserve currency. You have to understand that the global financial system runs on trust. It runs on the assumption that the United States is the adult in the room. It runs on the assumption that the dollar is neutral, stable, and boring. When the US government starts using trade policy as a blunt weapon against its own allies, when it starts creating volatility where there should be stability, that trust evaporates. Global investors, central banks, sovereign wealth funds, multinational corporations, they hate uncertainty. They can handle bad news. They can handle a recession. They can plan for those things, but they cannot plan for chaos. They cannot plan for a trade war that erupts overnight on Twitter. So what do? They pull back. They sell the dollar. They sell U.S. assets, and they look for a place to hide. They look for an asset that doesn't have a president, that doesn't have a foreign policy, that doesn't have tariffs. They look for gold. This Sell America moment we are seeing isn't just about politics. It is about the sudden realization that the political risk of holding dollars has skyrocketed. And when you combine political risk with the mathematical certainty of debasement, you get a stampede. But the geopolitical drama is just the spark. The fuel, the massive ocean of kerosene that is waiting to ignite, is the bond market. This is the boring part that nobody wants to talk about, but it is the part that will determine your financial future. We have to talk about the refinancing wall. The United States government is $35 trillion in debt. That number is abstract to most people. It sounds like a made-up number, but here is the concrete reality. A huge chunk of that debt is short-term. It matures every few months, every year. When a bond matures, the government has to pay it back. But they don't have the money to pay it back. So what do? They issue a new bond to pay off the old one. They roll it over. This is refinancing. In a normal world, this is fine. But we are not in a normal world. We are in a world where the buyers are going on strike. The foreign nations that used to buy our debt, China, Japan, Saudi Arabia, are stepping back. They are selling. So when the U.S. Treasury goes to the market to sell trillions of dollars in new debt to pay off the old debt, who is buying? The demand is drying up, and when demand dries up, the price drops. And when the price of a bond drops, the yield, the interest rate the government has to pay, goes up. This is the death spiral. As yields rise, the government's interest expense explodes. We are already paying more on interest than we pay for the entire military. If rates stay here or go higher, the interest payments will consume the entire federal budget. There will be no money left for Social Security, for Medicare, for the military, for roads, for anything. It is a mathematical impossibility. The government is insolvent at these rates. So why does this make gold and silver detonate? Because the market knows how this ends. The market knows there is only one way out of this trap. The Federal Reserve, the central bank, will be forced to intervene. They cannot let the U.S. government default. They cannot let the Treasury auctions fail, so they will do the only thing they can do. They will print money. They will create trillions of dollars out of thin air and use it to buy the government's debt. They will monetize the debt. This is not a theory. This is history. It has happened in every empire that got into this much debt. Rome did it. Weimar Germany did it. We are doing it. When the central bank prints money to buy the debt, they are diluting the currency. They are stealing purchasing power from every dollar in your pocket to save the government. Gold and silver are sniffing this out. They are front-running the inevitable liquidity flood. The price you see on the screen, $4,700 gold, $90 silver, that isn't speculation. That is the market pricing and the future inflation that is necessary to keep the system from collapsing. And then we have the third fire, Japan. You might be sitting in Ohio or Manchester wondering why you should care about the Bank of Japan. But you need to care, because Japan is the silent giant that has been propping up the global liquidity bubble for decades. For 30 years, Japan has kept its interest rates at zero or negative. This made the yen very cheap to borrow. Investors would borrow yen for free, convert it to dollars, and buy U.S. stocks, U.S. bonds, and U.S. real estate. This is called the carry trade. It was a massive, continuous flow of free money into Western markets. But now Japan is breaking. Inflation has finally hit Tokyo. The Japanese people are angry about the cost of living. The Bank of Japan is being forced to raise interest rates. When they raise rates, the free money spigot turns off. The carry trade unwinds. All that money that was flowing into U.S. markets starts flowing back to Japan. It is a giant sucking sound. Liquidity is being drained from the global system. When liquidity drains, things break. Volatility spikes, and when volatility spikes in the bond market, the big money gets scared. They realize that the safe assets, the bonds, are actually dangerous. They are losing value. They are volatile. So the capital rotates. It rotates out of the risk-free return of bonds and into the risk-free asset of gold. This is the structural shift we are witnessing. It is not just a trade, it is a migration. A migration of capital from paper to metal. Now let's look at the specific action in the metals this morning. This move was violent, it was vertical, and it happened during the Asian and European trading sessions. This tells us that this is a global move. It is not just American retail investors buying coins. It is global institutional capital moving. But the most exciting and terrifying part of this story is silver. Silver is trading in the mid-90s. For the silver stackers who have been holding for years, waiting for $30, then $50, seeing $90 feels surreal. But you have to understand the physics of silver. Silver is a tiny market. The total value of all the investable silver in the world is a rounding error compared to the stock market or the gold market. It is a small swimming pool. When a whale jumps into a small pool, the water goes everywhere. We are seeing a physical squeeze. The industrial demand for silver, for solar, for AI, for military tech is relentless. It is inelastic. These companies need silver to survive. They don't care if it's $30 or $90. They will pay it. But now, the investment demand is waking up. The general public is starting to realize that the dollar is dying. When you combine panicked investment demand with desperate industrial demand, and you try to shove both of them through the tiny door of available physical supply, prices go vertical. This is what a squeeze looks like. It isn't a slow grind higher, it is a sudden, violent repricing. The paper shorts, the banks that have been betting against silver, are getting blown out. They are being forced to cover their positions. They are buying at any price to avoid bankruptcy. This adds fuel to the fire. We are watching a short squeeze of biblical proportions unfold in real time. But I want to pause here and talk about the psychology of this moment, because this is where most people will make a mistake. When you see prices move this fast, your instinct is to feel two things: euphoria and fear. Euphoria because you are making money. Fear because you think it's a bubble that is about to pop. You think, I should sell, I should lock it in, this can't last. This is the wrong mindset for a currency collapse. In a normal market cycle, yes, you sell the rips, but we are not in a normal market cycle. We are in a currency crisis. The price of gold isn't going up because gold is changing, it's going up because the dollar is collapsing. If you sell your gold at 4,700, what are you getting in return? You are getting dollars. You are getting the very thing that is burning. Imagine you are on a boat that is sinking. You have a life jacket. The boat is the dollar. The life jacket is gold. As the boat sinks, the value of the life jacket goes up. People are offering you thousands of dollars for your life jacket. If you sell it, you have a pile of cash, but you drown. The goal is not to have the most cash. The goal is to survive the sinking. You hold the life jacket until you reach dry land. Dry land is a new monetary system, or a hard asset like productive land or a business. You do not trade the life jacket for paper while you are still in the water. This brings us to the question of what happens next. What is the playbook? We know what the central banks will do because they are predictable. They have a script. Step one is tough talk. They will come out and say that the markets are orderly, that the banking system is sound, that inflation is transitory. They will try to talk the market down. This might work for a day or two. You might see a pullback. Do not be fooled. Step two is panic. The bond market will ignore the tough talk. Yields will spike again. Maybe a bank fails. Maybe a hedge fund blows up because of the Japan trade. The plumbing of the financial system will start to seize up. Step three is the pivot. This is the moment of truth. The Fed will announce a new facility. They won't call it QE, quantitative easing, because that sounds bad. They will call it market functioning support, or temporary liquidity provision. But make no mistake, it is printing money. They will flood the system with fresh dollars to save the bond market. When step three happens, when the liquidity floodgates open, that is when the second stage of the rocket ignites. If you think $4,700 gold is high, wait until the Fed officially gives up on fighting inflation. Wait until they admit that they have to print to survive. That is when we see five figures. That is when we see silver in the triple digits. We are currently somewhere between step one and step two. The panic is building, but the official pivot hasn't happened yet. This means we are still early. I know it feels late. I know it feels like you missed the boat if you didn't buy at $2,000, but you have to zoom out. Look at the debt. Look at the unfunded liabilities. Look at the geopolitical fragmentation. We are in the first inning of a sovereign debt crisis. These crises play out over years, not weeks. The repricing of gold and silver is just beginning to reflect the reality that the U.S. government is bankrupt. So what should you do? If you are sitting there watching this video, feeling the adrenaline, feeling the anxiety, you need a plan. You need to stop reacting and start positioning. First, do not try to trade this market with leverage. Do not go onto a trading app and buy 100x leverage on silver futures. The volatility will wipe you out. The banks will engineer flash crashes to shake out the gamblers. They will drop the price $10 in an hour just to trigger your stop loss and then rip it back up. Do not play their game. Second, focus on physical possession. In a market meltdown, counterparty risk is everything. If you own paper gold or an ETF, you don't own gold. You own a promise. You own a liability of a financial institution. If that institution fails or if the market shuts down, you have nothing. You want metal in your hand. You want metal in a private vault that you control. When the system breaks, possession is the only law that matters. Third, watch the premiums. As the spot price rises, you might see premiums fall as a percentage, but the total cost will rise. However, if we get a true physical shortage where dealers run out of stock, premiums will detach from reality. You might see spot silver at $90, but you can't buy an ounce for less than $130. This is the unobtainium phase. We are getting close to this. If you see out-of-stock signs appearing on dealer websites, do not wait. Buy what is available. The window to exchange fiat currency for real money is closing. I want to address the FOMO, fear of missing out. It is a powerful emotion. It makes you do stupid things. It makes you buy the top of a candle. It makes you chase. But in this specific scenario, the greater danger is FOBO, fear of being obliterated. The danger of holding zero gold and silver is far greater than the danger of buying a little too high. If you have zero exposure, you are naked in a blizzard. You have no protection against the debasement of your labor. Even if you buy today and the price drops 10% next week, you still have the ounces. You still have the insurance. But if you wait and the price gaps up to $150 overnight, you are locked out forever. The wealth transfer is a phrase we use a lot, but I want you to really visualize it. Wealth is never destroyed. It is only transferred. When the currency collapses, the purchasing power doesn't vanish into the ether. It moves. It moves from the people who hold currency and bonds to the people who hold real assets. It moves from the creditor to the debtor. It moves from the unprepared to the prepared. We are witnessing the greatest transfer of wealth in human history. Trillions of dollars of value are moving from the paper economy to the hard asset economy. You have a choice. You can be on the side of the victim, watching your savings evaporate in an inflationary bonfire. Or you can be on the side of the beneficiary, watching your purchasing power expand as the world reprices reality. This morning was the wake-up call. The alarm is ringing. You cannot hit snooze anymore. The explosion in gold and silver prices is the market screaming at you that the time for complacency is over. The system is fragile, the debt is toxic, the trust is gone. This is not a drill, this is not a rehearsal. This is the main event. I want you to take a hard look at your portfolio today. Look at your 401k, look at your savings account. How much of it is dependent on the dollar remaining stable? How much of it is dependent on the government keeping its promises? If the answer is all of it, you are in danger. You need to diversify. You need to get off zero. Even if you just buy a few ounces, even if you just start today. Do something, take action, because the train is leaving the station, it is picking up speed, and it is not coming back. The physical squeeze I mentioned in the title is not just a catchphrase, it is a mechanical reality. The COMEX vaults are bleeding. The Shanghai vaults are sucking in metal. The miners cannot ramp up production fast enough. It takes 10 years to build a new mine. We cannot just print more silver. The supply is inelastic. The demand is exponential. This is the recipe for a super spike. We are going to see days where silver moves $5 out of $10 in a single session. We are going to see days where gold moves $200. You need to harden your mind for this volatility. Do not get shaken out. Do not sell your insurance because the premiums went up. Hold the line. The destination of this journey is a new monetary paradigm. We don't know exactly what it will look like. Maybe it's a gold-backed BRICS currency. Maybe it's a Bitcoin standard. Maybe it's a chaotic multipolar world of barter and hard assets. But we know what it won't look like. It won't look like the US dollar dominance of the last 50 years. That era died this morning. It died when gold crossed $4,700 and the bond market didn't blink. The illusion is shattered. The reality is here. I want to leave you with this thought. Years from now, you will look back at January 2026. You will tell your children or your grandchildren about the time when money broke. They will ask you, what did you do? Did you see it coming? Did you protect us? Make sure you have a good answer. Make sure you can tell them that you saw the signs. You saw the fires in Europe, in the bond market, in Japan. You saw the detonation on the charts, and you took action. You became your own central bank. You secured your family's future. This is your opportunity. It is scary, it is chaotic, but it is also the chance of a lifetime. Do not squander it. Stay alert. Stay skeptical of the official narrative. And keep stacking. The world is changing fast and you need to change with it. The fire is burning, but you have the fire extinguisher. Use it. We will continue to track this every single day. We will watch the bond yields. We will watch the Japanese yen. We will watch the physical premiums. We will not let you walk through this alone, but you have to take the first step. Welcome to the new world. Welcome to the breakout. Let's navigate it together.